September 1929. In Manhattan, a businessman felt a wrongness he couldn't quite articulate. Stock prices had been climbing for years, but beneath the glow of prosperity, the base was cracking. On a Tuesday morning, trusting instinct and a rising sense of dread, he entered his bank, handed over his passbook, and withdrew everything, $12,000 in cash, packed into his briefcase. By Thursday, just 2 days later, the market collapsed with a violence that would echo for generations. Around the country, banks buckled as crowds of frightened depositors lined up outside locked doors. He was all right, because he already had his money in hand and could ride out the storm. Now, move that scenario to the present. You sense danger in 2026 and try to do what he did. Pull your wealth and get out before everyone else wakes up. You log into your 401k and see $180,000 built over 20 years. You click Withdraw, and an on-screen calculator appears. Federal tax, state tax, and a 10% early distribution penalty for touching funds before age 591(2). Your $180,000 turns into $98,000 before you receive a cent. And it gets worse. The withdrawal isn't instantaneous. It goes into a queue 7 to 10 business days in normal times. During a panic, when many people try to exit at once, those pipelines can stall altogether. Not because your bank is necessarily insolvent, but because the modern system was constructed to prevent exactly what that 1929 customer did escape. This is the underappreciated gap between 1929 and 2026. The point isn't merely that another break may be coming. It's that when it comes, you won't be able to do what earlier generations could, grab your money and run. Your wealth sits inside mechanisms with time locks, penalty gates, and legal barriers that snap shut when the crowd moves together. Every one of those features was built deliberately, not to safeguard you, but to protect the system from people like you making the rational choice to preserve themselves when trouble approaches. The 1929 disaster was about speculation, leverage, and debt. The 2026 disaster would be catastrophic for a different reason. Digital cages that block the exits even for those who anticipate the blow. Here is how we arrived here, why the restraints have never been tighter, and why 2026 makes 1929 look like a rehearsal. The 1929 crash destroyed millions of lives, yet it preserved one feature that our era has removed: immediate access to your own money. That distinction is central to what's been lost. In 1929, a savings account was simple. You walked into a branch with a passbook, a small ledger with handwritten entries, and asked for your balance. The teller counted out cash from a drawer. Same-day withdrawal of the full balance was routine. There were no waiting periods, no layered approvals, no suspicious activity reviews. If the funds were yours, you could have them within the hour. Stock ownership was similarly direct. When you bought shares, you received physical stock certificates, decorative paper documents listing your name and the number of shares. They weren't just digits on a database. They were property you held. To sell, you could locate a buyer and hand over the certificate for payment, or go through a broker with settlement in 3 days. Not 3 weeks, not dependent on ad hoc trading halts beyond established rules. 3 days, consistently. Investors who sensed danger in September 1929 had options. They could unwind positions, take deposits out, and shift to cash or gold. Plenty tried. The system didn't stop them. The failure was that most didn't recognize the risk early enough. When the break arrived on October 24, 1929, those who were already in cash or gold kept their footing. Those who lingered, accepted official reassurances, or waited another day were wiped out. But the devastation came from their choices, not from a mechanism that refused to execute. Banks that failed didn't preemptively lock every account. They didn't impose withdrawal limits or require management sign-off for large requests. They ran out of money because too many people withdrew too quickly. That's a bank failure savage, but fundamentally different from what we have now. Margin was equally unambiguous. If you put 10% down and financed 90%, a drop triggered a margin call. If you didn't meet it, the broker liquidated on the spot to recover the loan. Harsh, immediate, transparent. You knew your status at all times. Set that next to today's retirement accounts, fenced in by penalties until age 591(2). Set it next to banks that can pause activity for suspicion if you try to remove funds rapidly. Set it next to funds that can lawfully suspend redemptions when markets strain. The 1929 cohort faced a brutal downturn, but not a system structured to trap them. We live in one. After 1929, policymakers didn't just try to stop a replay. They built something broader, a financial architecture that could keep people from fleeing in a crash. From the reforms of 1933 through 2010, a single thread runs through. Remove the ability of ordinary savers to spark runs and cascades by pulling their money. The first lock was the 401k, created in 1978 and presented as a tax benefit. Look at what it became. Roughly $7 trillion in U.S. retirement assets behind penalty walls. You pay in across your career, but cannot access it without incurring combined taxes and penalties that typically consume 35 to 45% of what you take out. Penalties are only the first lock. Time is the second. A 401k distribution request doesn't produce money on the spot. Plan administrators process such requests, typically over 7 to 10 business days in ordinary conditions. In stress, when everyone clicks at once, the timeline stretches. Some providers can legally halt distributions entirely for administrative review or because plan asset values are uncertain. In 2008, that happened. Fidelity, one of the largest administrators, suspended certain withdrawals for weeks. Participants logged in to see temporarily unavailable. Their balances were visible on the screen, but out of reach, not for lack of funds, but because the rails include gates that come down during turbulence. Cash access has also narrowed inside traditional banking. Try withdrawing $10,000 or more in currency. Federal rules trigger a currency transaction report to FinCEN. Banks can also delay your request for a suspicious activity review if the pattern looks unusual. Daily ATM caps, often $500 to $1,000, mean that even with $50,000 in checking, getting it out as cash could take 100 separate transactions over weeks. The crisis could end long before you retrieve your own money. Investment accounts, mutual funds, ETFs, and brokerage holdings hide a different trap. Your ability to sell depends on market makers staying active. That liquidity vanishes exactly when you need it. In March 2020, more than 200 exchange-traded funds traded 10-20% below the value of their underlying assets. A $100,000 ETF position might fetch only $80,000, $90,000, not necessarily because the portfolio fell that far, but because market structure misfired. Mutual funds embed explicit constraints. Under SEC Rule 22E4, funds may hold up to 15% in illiquid positions. When thresholds are breached, redemptions can be suspended outright. That's not a hypothetical. The Woodford Equity Income Fund in the UK froze withdrawals in June 2019, trapping roughly $3.7 billion for more than 3 years. When distributions resumed, investors received about 70 cents on the dollar. Real estate investment trusts did something similar in 2008-2009, suspending redemptions for roughly 18 months on average. Private equity funds standardized 7-year lockups with no early exit. Each of these features was sold as investor protection or market stabilization. The outcome is the same. Your money is no longer on demand. It's available on the system's schedule under conditions that tighten precisely when danger flares. The 1929 investor could collect cash and leave. The 2026 investor will click Withdraw, watch a loading indicator, and discover a pending request delayed or suspended if conditions worsen. By the time access is granted, the value they hope to preserve may have already eroded. These mechanisms are already in place, embedded in retirement plans, bank accounts, brokerages, and funds, waiting for the moment when everyone turns toward the exit. The traps are long-standing. What makes 2026 different is the substrate beneath them: record debt, automated trading, and a Federal Reserve with limited room. Start with leverage. In 1929, investors could buy with 10% down, borrowing 90% 10.1 leverage that converts a 10% slide into a wipeout. Regulators later raised margin to 50% and declared victory. But now, leverage has migrated into derivatives, collateralized loan obligations, and private equity structures, creating 20-50.1 exposure out of sight. When that unwinds, it won't play out over months like 1929. It will happen in hours as machines fire pre-programmed sell rules. Unlike the open outcry floors of the past, roughly 70% of the trading volume is algorithmic, pushing millions of orders per second. Those systems sell when volatility crosses set thresholds, when momentum breaks, when correlations indicate stress. One cascade triggers another. Humans can't keep up. We already saw the preview in March 2020, when the S&P 500 plunged 34% in 23 days, the fastest bear market on record. Circuit breakers halted trading multiple times to cool nerves. They didn't end the selling. They condensed it into tighter bursts, with more violent moves when sessions resumed. Now, overlay the existing locks. Your 401k falls 30% in 2 weeks. You submit a distribution request, prepared to take a 40% hit in taxes and penalties. It remains in the queue as markets shed another 20%. Approval lands after a 50% drawdown, then 40% is removed from what's left. A $200,000 account yields $60,000. That assumes approval at all. In peak crisis, plan administrators can invoke extraordinary circumstances, clauses, and suspend distributions entirely. You watch the balance shrink, powerless caught by systems designed to restrict access in such moments. Banking is no safer. In 1929, institutions failed because they couldn't call in loans or liquidate assets quickly enough when depositors demanded cash. Today, banks hold more reserves and operate under tighter rules. Those reserves don't matter if the payment rails seize. Modern finance runs on digital plumbing, Fedwire for large transfers, ACH for everyday flows, SWIFT for cross-border payments. Every pipe has throughput limits and can choke when stressed. In September 2019, during expansion, not crisis, the overnight repo rate jumped from around 2% to about 10% in a single day. The Federal Reserve injected $75 billion to keep the system functioning. That was in calm weather. In true panic, those channels can stall. Silicon Valley Bank provided a more recent case study. In March 2023, it went from concern to seizure in roughly 36 hours. Customers learned on Thursday afternoon that the bank was in trouble. By Friday evening, regulators intervened. Depositors with balances above $250,000 had no access until the FDIC set up a bridge bank the following Tuesday, 4 days, without funds. For businesses with payroll and vendors due, those 4 days were existential. Scale that dynamic. Not one regional bank, but many. Not a few billions, but trillions in deposits. The machinery doesn't scale gracefully. The FDIC's insurance fund held around $125 billion to cover roughly $10.5 trillion in insured deposits. If even 5% of banks fail at once, the arithmetic breaks. Meanwhile, the policy arsenal is thinner. Interest rates hover near 5%, leaving little room to cut. The Fed's balance sheet is already swollen from quantitative easing. Federal debt is around $35 trillion, shrinking the space for massive stimulus. In 1929, at least people could attempt to save themselves, withdraw cash, and buy gold. Today, the exits have been narrowed on purpose: digital gates, penalties, processing delays, legal constraints set to engage when the crowd bolts. The Great Depression's market took 4 years to find its bottom, partly because people could get out and sit in cash. The 2026 downturn would likely move faster and cut deeper precisely because they cannot. The crash hasn't arrived, but if you know where to look, early movements are visible, not in headlines, but in the quiet choices of those with the most to lose. Corporate insiders, sovereign wealth funds, and institutions with information you'll never see. In Q4 2024, U.S. insider selling climbed to highs not seen since 2021, about $16.2 billion over 3 months. Executives exercised options and sold at nearly 4 times typical rates. These aren't retail accounts spooked by volatility. They're CEOs, CFOs, and directors who see the next quarter before the public does, who sit in rooms where real problems are discussed. When insiders sell, they're not aiming around a 10% correction. They're getting liquid before a larger break. Sovereign wealth funds made analogous shifts. Data from late 2024 showed a move out of U.S. equities toward gold, commodities, and short-duration bonds. Norway's government fund reduced equity allocation by roughly 18% in 2024. Abu Dhabi's fund increased gold holdings to levels last observed in 2008. These investors don't panic. They run trillions with long horizons. When they lean defensive, it's because their models justify trading upside for capital preservation. Then there's the Treasury market, the $27 trillion foundation of global finance. In October 2024, signs of strain appeared. Bid-ask spreads widened. Large orders that used to nudge yields by a few basis points began causing 15 to 20 basis point swings. That's the kind of illiquidity that prefaces breakdowns, a shortage of market makers willing to take the other side. When even treasuries become jumpy, confidence at the core is thinning. Meanwhile, the public narrative hums along: strong economy, acceptable earnings, valuations vindicated by innovation. It's the same refrain heard in 1929. This time is different. It never is. The Shiller PE reached around 39 in October 2025. It hovered near 32 before the 1929 crash and around 32 before the dot-com peak. Today's level sits roughly 23% above both. The news story says artificial intelligence justifies multiples that previous generations would have called extreme. The yield curve has been inverted since July 2022, now more than 3 years. Every recession in the last 70 years was preceded by an inversion, typically 12 to 18 months ahead. We are roughly 39 months into inversion, well beyond the usual lag. What makes this moment uniquely dangerous is that all of these warnings are flashing while the trap architecture is fully active. In 1929, the exits were open even if most people didn't use them. Today, those who see the risk insiders, sovereign funds, institutions, are already shifting. The typical saver with a 401k and a checking account hears familiar counsel: stay the course, keep contributing, ignore noise. In practice, they're being lined up as exit liquidity, the last buyers before the gates shut. History doesn't repeat perfectly, but it rhymes in patterns that are easy to recognize. The 1929 collapse wasn't random chaos. It was the arithmetic result of too much leverage, too much speculation, and the belief that old boundaries no longer applied. The 2026 version follows the same pattern with one decisive difference. When it hits, you won't be able to do what the survivors of 1929 did. You won't walk into a branch and withdraw a life savings by late afternoon. You won't liquidate positions without heavy penalties, long processing times, or the risk of outright suspension. You won't have the freedom to act because the system was designed to discourage mass exit. Think back to that businessman in September 1929. He survived because he acted before the crowd accepted reality. He didn't need authorization. He didn't sit through processing delays. He didn't pay penalty tolls or hope the rails wouldn't freeze. He recognized the risk, took possession, and got out. That option is largely gone. The exits that saved him have been closed. Yet choices remain. You can accept that the locks exist and navigate within them. You can scale back fresh contributions to penalty-bound accounts, directing new savings to accessible pools even if it means surrendering tax advantages. You can assemble liquid reserves outside the retirement framework, preferring today's tax bill to tomorrow's access risk. You can watch how insiders handle their own money. When leaders sell while advocating that you buy, the mismatch deserves scrutiny. Or you can do what most will do. Trust the structure, accept the soothing lines, keep funding accounts you can't reach in an emergency, and assume that this era really is different, that algorithms and AI ended the business cycle, that central banks can eliminate true pain, that markets only rise if you wait long enough. Every generation has made the same claim with new labels. The 1920s believed industrial technology guaranteed permanent prosperity. The 1990s believed the internet rewrote economic rules. The 2020s believe artificial intelligence has neutralized risk. It's the same idea in new clothing. People who make it through crashes aren't necessarily the brightest or most connected. They're the ones who recognized the pattern early, who were willing to look cautious while others celebrated, who understood that preserving capital matters more than chasing the last 20% of a stretched boom. The locks are in place. The indicators are brighter than they've been in decades. Insiders are inching toward the exits while telling the public to stay invested. The question isn't whether a break is coming. It's whether you'll be pushing toward doors that no longer open held back by digital gates while your balance shrinks, or whether you'll already be outside the cage before it closes. Your grandfather's generation could take cash and run. You can't, not in the same way. But preparation is still possible while the window is open. Once everyone tries to leave at the same time, the gates come down, the pipes seize, and the wealth you believed you had becomes a number on a screen that ticks lower by the hour while you watch, unable to act. The choice remains yours. The timeline is narrowing.